This is Brant from Wolf on Wall Street Trade, which is soon going to be a new website. So from there, it was a holiday shortened week. I have a chart of the S&P 500 and what it looked like as we ended last week. And as I said, it was a holiday shortened week. Kind of felt like it was 2 weeks to me in my own life. But, 50 years of life experience teaches you that you can be in a weird place for a little bit, but that always kind of passes. And the reason I kind of bring this up, if you understand price action, just price action alone, what price at its purest form depicts is mass sentiment, mass emotion. So in life, we have different emotions. We have fear or anxiety. So you might have fear of the unknown. That's like anxiety in the future. Or regret. So that's in the past. In relationships, you have fear that you're not enough or that you can't be loved. In the market, there's two essential emotions that run price, and they are fear and greed. So we know what some of the fear things are, and we certainly know what greed is. And once you really get to understand that and look at price as a function of those two driving dynamics, those two human emotions, you start to understand price action. You start to be able to understand what the price chart is telling you, and you start to get a feel for where you are, where you're at. If I pulled up a map of the US or of the world, I know what country I live in. I know which way is north, east, west, south. But if I were to throw you into the fictional land of Westeros from Game of Thrones, and you suddenly found yourself in this fictional land, you wouldn't have any idea where you are or where you're going. You don't know if you're in Westeros or Easteros. You don't know which way is north, south, east, or west. And most importantly, you don't know you are here. So that's what we try to do in analyzing the market, is understand what the map, the geography is, what the you are here point is, and how to get where you're going, whether that be north, west, east, south. You have to have some context. And that is really one of the most important things in the market. You can pick stocks all day long. So 90% of the stocks are going to move with the primary trend of the stock market. And then on top of that, you have sectors. Some sectors in a certain environment will do better than others. And then you have subsectors below those. Individual stock picking can be good. A lot of those stocks can move more than the broader market. But if you don't understand which way the broader market is, which way north is, which way south is, and where you are here is, it doesn't matter. You can pick the greatest stock in the world. 90% of them are going to move with the broader market. That's what we're trying to achieve in technical analysis. Or what I do is more than technical analysis, is like cross-asset analysis. I look at a whole bunch of different assets, from bonds, currencies, the equity market, commodities. They all tell you something. They all give you a little bit of information about this map. So that's what we're trying to achieve. And then once you understand that, if you want to pick individual stocks, that's fine. If you want to play the broader market or sectors, that's fine too. But you have to know the map, you have to know what the directions are, and you have to know we are here. Okay, so that's what we're trying to achieve. Things change in the market. It's never static. So wherever you are in life, that's not a static point. It's going to change. It may be you're in the best part of your life, it'll change. It may be you're in the worst part of your life, it will change. Same thing with the market. More to the point, price action is a depiction of mass emotion or mass sentiment. Price is just a depiction of fear and greed. Pulling away from my dime store theology, we'll go back to the S&P 500, something to know a little bit more about. This is what we looked like last week, bull flags. This was the last bull flag. Here's the flag pole, and here is the flag. This is why we call it a bull flag. It looks like a flag flying on a flag pole. So a bull flag is always a big move up, which is your flagpole, and then the flag, which is a parallelogram that consolidates against the preceding trend. So it looks like a flag. Here's another one. This is where we left off last week on last week's video. Okay, so coming into this week, we definitely had a bullish setup And if you're a subscriber, if you're listening to these videos on YouTube, you saw last weekend's video, hopefully, or you can go back and watch it. If you're a member, you know the one thing that I had a concern about this week was that when we see a bull flag, what we want to see is big volume here on the advance, and then we want to see volume falling back, declining on this consolidation. And then when it breaks out, we want to see volume increasing. Now, the problem that I had with this week is that it was a holiday shortened week. What that means is that we have basically Monday where volume is going to be pretty typical. Tuesday, you could consider it to be pretty typical, but because we had the release of the Federal Reserve minutes or the FOMC minutes on Wednesday, Tuesday traders are going to pull back because there's that risk event out there Wednesday. They're not going to want to chase prices higher into the unknown, which was the FOMC minutes release from the last meeting Wednesday at 2 p.m. So that means we can expect volume not to be too heavy Tuesday or Wednesday, and then as we go into the rest of the week, Thursday, the market's closed, and then a lot of traders are just going to take Friday, which was a half day, off. They're going to make it a 4-day weekend, and these Wall Street guys are going to go down to the Hamptons and do their thing. That means there's no volume in the market. That means if we did have a breakout here, it would be very difficult to judge whether it's just that holiday decline in volume or whether price really didn't have a strong breakout with strong volume. So if we look at this flag again, I'll just pull up a little bit closer, and what I'm going to do is pull up the SPY to show you volume. So pull up volume here. This is exactly what you want to see in a bull flag. You want to see volume, or any bullish consolidation. You want to see volume taper off into that consolidation. Otherwise, big spikes of red volume or whatever that may be, that indicates selling. You don't want to see that in a consolidation. What you do want to see on the breakout is volume increase again. So you can see the conundrum with this week that volume was going to taper off no matter what because of the Federal Reserve minutes on Wednesday, the market being closed on Thursday, half day on Friday when most traders aren't going to come in anyway. That was kind of my concern about this week. It actually worked out beautifully. All the averages closed up on the week. The S&P was up 1.5%. So they did move higher, but that is not what I would consider a strong breakout. So let's go back to the S&P 500 chart and see what the rest of the week looked like. And now all I'm going to do is roll the chart forward to see what happened this week. There's our bull flag. So, oh wow, that could be a breakout right above 4,000, right? But this is not a definitive breakout. Why? Because it's not making a definitive higher new high. Bull flags are bullish. They have a high probability of breaking out to the upside, but this is the most dangerous spot in a bull flag. If you get what I'm going to call a half, well, I don't want to say that because I don't want to get demonetized or banned, but if you get a weak breakout, there is a good chance that it is a failed breakout. Failed breakouts turn into fast reversals more often than not, very quickly. What I always do is I keep my trend lines on one chart, and then I have no trend lines and I look at price action on another. Because when you see these trend lines, you're like, okay, that's a bull flag and here's a breakout, and it didn't quite do what I thought it was going to do. That is because you have this one perspective. So I keep this other chart with no trend lines and I look at price action, and this is what I saw on the week. And this does happen often. Not a majority of the time, but it does happen often where a consolidation that starts with the bullish tone will morph into something else. So this week, it morphed into these two trend lines right here and here, which is a bullish ascending triangle. Think of this as like a spring coiling up, getting ready to release its energy. So we have this area of resistance, and then we have a trend of higher lows. So every time price comes down, buyers are getting more aggressive and they're buying it at shallower dips. That is a bullish consolidation. It's just as bullish as a bull flag. It has one advantage to it that a bull flag doesn't have, and that's that these two trend lines are eventually going to converge. Most of the time, you're going to have a pattern like this break out about 2/3 of the way into that pattern where it converges. And this particular pattern will converge. The trend lines will come to an apex next Friday, which happens to be the payrolls report. So if I rolled this chart forward, by next Friday, right here, I'll put a pointer. There's Friday. You have an apex in that triangle. So usually a strong consolidation like this will break out, typically might come down one more time, break out about 2/3 of the way into it. But generally speaking, even if it breaks out at the apex, this gives you a good idea of how much longer it can be in consolidation. Whereas a bull flag, you more have to judge it. If you look at enough bull flags and you know what the prior trend was, you kind of have an idea of how big they should be, but they don't have this feature where the two trend lines converge and give you a point in time. So bullish pattern converges next Friday going into the payrolls report, which is just a couple weeks before the December FOMC. And what is the Fed the most worried about right now? Wage inflation, job growth. They want to see the job market come down. They want to see the unemployment rate go up. So if we get a weak payrolls report, it's going to be bullish for the market. So if I pull up the NASDAQ 100, we have the same thing, that kind of bull flag from last week, and then what would be a not great breakout, not a definitive breakout from that bull flag. But if we take a look without the bias of these trend lines, what you'll see is that this smaller bull flag morphed into a larger bull flag, which is fine. This is actually, to me, an ideal situation, and it really materialized Friday. I was kind of worried about this at the beginning of the week. I told members exactly why, with the whole volume thing and the holiday volume and the Fed in the middle of the week, all that stuff. So this was really an ideal scenario that occurred, that developed, that these consolidations became a little bit bigger, but they maintained their bullish bias. I couldn't imagine a better scenario if I was, on a bullish side and I could, control price and I was drawing this chart myself. I couldn't imagine a better scenario than these bullish consolidations just expanding and becoming a little bit bigger. The only area where it didn't happen was the Dow Jones Industrial Index. The Dow was the biggest price percent gainer, like a historic gain in October. It broke out from its bull flag and it went higher. So this is the only exception. We also had technical levels that were kind of nearby or in the area, and you don't want to try to take on a technical level without that volume to really push through it. Pull up the S&P 500, and we'll go to a daily chart with some moving averages. You see that 200-day moving average? Last week I told you the S&P respected this 100-day. It didn't come down to 3,900. Like I said, I would be more than comfortable with a consolidation doing that. Found support right at the technical level. Let me show you one other example real quick. And that's going to be small caps. I'm going to use IWM here. Look at that, a 200-day. So I mentioned last week, it poked above this 200-day. We had some long upper wicks on the candles. That is a rejection of higher prices intraday. And it's right along that 200-day. And we see it here again. So technical resistance. So the market really needs that volume. It really needs that conviction to break out of those consolidations, to break above these technical levels. I'm actually glad it didn't try to do it this week on the low volume with all these things, because it would be very difficult to determine whether or not it was just seasonal volume because of Thanksgiving and the Fed and all that, or if it just wasn't a strong breakout. So going back to our S&P 500 chart, one of the main pivotal events this week was the minutes from the last FOMC meeting, the last Fed rate hike policy statement meeting. So kind of what all the members said. So if we zoom in on this chart a little bit, maybe 5 minutes or so, we can find the FOMC was right here. So we got a little bit of a dovish reaction. Basically, the gist of the minutes were a lot of the voting members of the FOMC said that they want to kind of taper back the pace of rate hikes. So they don't want to do the 75. They're definitely probably going to do 50 basis points in December. They may go down to 25. They want to kind of pull it back a little bit because they see the financial stress in the market. They also know that the rate hikes that they're doing take 6 to 9 months to filter into the economy. So what we're seeing right now are just the initial rate hikes from March. So the rate hikes that we just got in the last meeting won't show up till next year. And all of the economic data is at least 1 month lagging. So they don't want to over tighten. The only thing they fear more than inflation is a breakdown in the financial system. And there's been evidence of that because of the tightening, because of the strong dollar. We've seen evidence of stress in the financial system. Bond market liquidity has been really low. The FRAOIS spread, which is kind of a barometer of stress in the system, has been spiking since September. So the gist of the meeting was that they want to kind of dial back the degree or the intensity of those rate hikes, but they also saw the terminal rate being a little bit higher. But keep in mind that this was before the CPI, Consumer Price Index, came in much weaker inflationary wise than expected, and that was followed up by the Producer Price Index, which was also much weaker. So this Fed decision was before those things came out. So their next decision, they're going to have seen what CPI did, what PPI did. They're also going to know what the payrolls report that's out next Friday is going to do. So if the payrolls report shows weakness, shows wages coming down, the unemployment rate going up, they are going to be even more dovish, okay? And that is what the market needs right now. That's what the market can rally on. It's kind of a weird oxymoron, but bad news economically is good news right now as far as economic growth. Not inflation, but economic growth. They want to pull down economic growth. They want to pull down consumer demand to fight inflation. Let's take a look real quick at what yields did on the week. If you watch my prior video from last weekend or the weekend before that, you'll know what my kind of view has been of what rates are going to do. So we're going to pull up the 10-year yield, and we don't want that on a log chart. So massive uptrend since August. This has been weighing on the market. This has been weighing on mega caps big time. Here is the breakdown in yields from that trend. That's the CPI report. Then the PPI report. These are bearish flags here. So on this week, bearish flag. This suggests that yields are going to go lower, which is good for stocks, and it's especially good for the most influential handful of stocks that move the market the most, the mega caps. So yields were down across the curve on the week. So what the actual price charts of yields have been are bearish. They've been suggesting since this breakdown that yields are going lower. The dollar has been suggesting the same, and we saw that this week. The yield curve, the 2-year, 10-year yield curve, has been, since World War II, like one of the best predictors of economic recession in the US. Now remember what I said before, it takes 6 to 9 months for a Fed rate hike to filter into the economy and actually be felt. So we're just feeling the initial early rate hikes from like March of this year. We're not feeling the recent ones. This is a chart that I lifted from the St. Louis Fed, their website Fred over here. It's the 2-year, 10-year yield curve. And these gray areas are recession shading. This is the curve. That's steepening. This is flattening. This black line is the zero level. So this is inversion. When it drops below that black level, this curve is the most inverted in 40 years. So basically the most inverted since the last time we had a big inflationary problem. This is telling us very, very high probabilities of a recession next year. We've already been in a technical recession this year, although nobody wanted to admit it, because we had 2 back-to-back quarters of negative GDP. I want to point out something real quick. Look at these recession shading areas. What is really interesting, inversion, like right over here, is a high probability signal of a recession coming. And everybody and their mother who's been in the market knows this. Inversion, we can see all these recessions. But what they don't know is that the inversion is just the first part. The steepening, the sharp steepening right after an inversion, which is right here, right here, right here, that is the signal that a recession is imminent. And usually the reason we get that is the Fed is cutting rates because they know it's coming. So we have basically the deepest inversion of the 210 curve since the early 1980s, 40 years. I'm going to show you a few other things that I think are bullish, in my opinion. If you're a member of the website, then you know these things. You're seeing them in real time as they occur. What I will show you is my custom credit index. I have it under my leading indicators. So let's pull that up real quick and just kind of look at that compared to the S&P 500. Very, very bullish action in credit. So I pointed this out last week. When the S&P was pulling back last week and it looked like a small bear flag, we had a positive divergence in credit. So this week, where we have this kind of ascending triangle in the S&P, look what credit's doing. It's leading higher. That is a bullish signal. The US dollar, I've been talking about this a lot. The two primary driving forces of the market right now are the dollar and yields, but inversely correlated with the S&P 500 or stocks. The dollar index was down about 0.75% this week, and also down 5 out of the last 6 weeks. Let's pull up a price chart of that real quick and look at the price action. And what I want to show you is the dollar index coming down and making a bear flag right over here. This is how we kind of came into this week with the bear flag. I'll draw it in real quick. But just like the S&P 500 didn't make a definitive breakout from that bull flag from last week, it changed into something else. The dollar index, here's the CPI report, that sent it lower, didn't make a definitive breakdown either. But if we take a closer look at this area towards the end of the week, what do we have here again? Another bear flag in the dollar. So the dollar is saying bearish price action in the dollar, which is good for stocks. Now, because the dollar and yields have been reflecting the same thing, we can look at those two and see what probabilities suggest. So what I'm going to do is pull up the 10-year Treasury futures right here. And I'm going to add the dollar index, but I'm going to invert the price. And I back that out to a 2-hour chart. So you can see how close they track together. The red and green candlesticks are the 10-year Treasury, and the blue line is the inverted dollar index. You can see how close they track together. So we could look at this another way, and we could say that basically yields are following the dollar. This is dollar weakness because I inverted the price. This suggests, again, that yields should go lower, treasuries should move higher, yields and treasury prices move in the opposite direction of each other. We have a positive divergence right here, but it's still leading much, much higher. So if you know what the dollar is going to do, or what the dollar is suggesting, you have an idea of what yields are going to do, then you have an idea of what is going to move the stock market. Probabilities, we're looking at that map. We're saying, here's north, here's east, west, south, and here is the point. You are here. It's all probabilities. Take fear out of it. Take greed out of it. Take emotion out of it. Look at objective evidence. The more objective evidence you can compile, the higher the probabilities are in your favor. Since we're talking about the dollar, I have to bring up gold. Now, gold is typically a safe haven asset, and it's typically an inflation hedge. I talked about this, I think, last weekend in the video, that a lot of old-time gold bugs, these are people from the late 70s, early 80s, when we had that massive inflation, and gold was an inflationary hedge. Gold acted really well, and these gold bugs are beside themselves. They cannot understand why gold is not acting better than it is. I can't explain it. All I can tell you is that gold has the same two drivers as equities, inverse correlation to the dollar and to yield. So if you look at gold's price action and the S&P's price action, it's not exact, but it's very, very similar. And of course, that would apply to other precious metals like silver, the gold miners, and all that stuff. So to illustrate my point, I'm just going to go back to this chart, the inverted dollar and the 10-year yield, but I'm going to change this to gold futures. Look at this correlation. Very, very, very strong inverse correlation. Gold is moving down when the dollar is moving higher. Gold is moving higher when the dollar is moving down. Remember, this blue line is the dollar index, but inverted. So this is bullish for gold, moderately bullish. Let's say moderately bullish. Gold is consolidating right over here. Look at volume. It's falling off, so that is good. Let's take a look at just gold and see what kind of price consolidation we have. I'm not sure if I shared this in last weekend's video, or maybe the prior week, but I've been pointing it out to members. Gold has not been acting well. It has not been my favorite asset by a long shot. But then we got this kind of W bottom base, the same kind of W bottom bases that we saw in the Dow, in small caps, right here, right at that 1620 level. And then we got this rally off that level with the CPI report. Here's the consolidation. I'm going to go to a 60-minute chart. And I just want to point out that gold had this big run off 1620, right? And there's the $1,800 level. It has been a massive psychological level for gold. Gold had this big rally. It's not going to blow through 1800 without consolidating first. What kind of consolidation is this? Let me draw the trend lines. And there they are. Does that look familiar? That's a bull flag, just like the NASDAQ 100, because gold is trading so similar to stocks, being that's being driven by the same two forces as stocks. So this does suggest that gold will break out to the upside and blow right through that $1,800 level. This is the first time in a long time that I've even seen the hint of something interesting on the bullish side in price action for gold. But again, what does it need? It needs a lower dollar. It needs lower yields. That payrolls report next Friday is going to be key. And then mid-December, the Fed or FOMC policy statement is going to be key. Now let me wrap this whole video up. Way longer than I thought it was going to be. But I want to show you one last thing with those bullish consolidations that just became bigger this week. The ascending triangle, it is bullish. I always say this because I see it 90% of the time. When a measured move is hit, and our measured move for the S&P was 4,000, the most probable scenario is that price will consolidate in the area. What is it doing? Consolidating in the area with a bullish bias. So one other thing I was looking for was the 3C charts to improve. That's my own money flow indicator. And what I did to reduce a little bit of the bias of this week's lower volume was went to a little bit longer time frame, a little bit longer trend in 3C. So what I would expect to see is 3C weaken a little bit here, giving us that pullback, correction, consolidation signal. And then somewhere in here, as we see a bullish pattern in price develop, to see 3C improve. So let's take a look at those charts. This is the SPY, the ETF for the S&P 500. Here is that exact thing I was just saying. A consolidation signal right here with a small negative divergence. 3C is not making a higher high with price. Price pulls back, looked like a bull flag last week. Now it looks like a bigger ascending triangle. But notice what happens after this kind of pullback signal in 3C. We get this nice positive divergence. Price is pulling back. 3C is positively diverging as it's hitting that lower trend line of the bullish consolidation. And over here, it's even leading higher. I'm just going to run through these real quick. Pull up QQQ for the NASDAQ 100. Same thing. We have the negative divergence here, which is not a big divergence. It's not saying like massive distribution. It's saying prices are tired here. We should expect some kind of consolidation. Here's the consolidation, a bigger bull flag in NASDAQ 100. Here's the positive divergence, just like SPY. Here's the leading divergence. Let's take a look at small caps. Basically the same thing. We have a little bit of a weaker 3C signal here suggesting that pullback, and then into the pullback, the positive divergence in 3C. The only average that's a little bit different is the Dow. And over here, it's just confirming price. Remember, it did break out of last week's bull flag. So what this tells us is that what you see is kind of what you get in price. There's no underlying pattern of distribution into higher prices. It is confirming, and that's fine. So the bottom line, the takeaway is I couldn't really imagine a better scenario. I was a little bit worried at the beginning of the week because of volume. I couldn't imagine a better scenario for the market in a holiday shortened week with lower volume than to just consolidate more. The consolidation in the S&P, which is that ascending triangle, and the S&P is the benchmark index, suggests that we will reach that apex by Friday. The payrolls report is out, ironically, Friday morning before the open. So we're set with a pretty strong looking set of charts here for some more upside, but it may not happen until we get that payrolls report. Otherwise, I see no reason to be short the market here. I would rather be long, but you have to be aware of the fact that this is a bear market rally. Bear market rallies are strong. You don't want to get sucked into believing that, this is the market bottom. We're going into a new bull market trend. Just play the bear market rally if you want, but be aware that's what it is. And with that, I am going to go get my camping stuff ready and enjoy a beautiful weekend out in nature. You got to have this video without me doing it in a tent like 2 weeks ago and crickets in the background and all that stuff. So if you like the video, I think down here at the right side, you should see a subscribe button. And then you can also hit the bell just below that and you'll get notifications when my new videos are out. You can also subscribe to the channel from a link I'll put in the description, and I will put a link to the website if you want to subscribe to that. You will get the 2008 rates before the new website comes out, I think before the end of the year here. Prices will go up a little bit, so you can beat inflation with that. Anyway, everybody, I hope you enjoyed this. I know it's a little bit long, but I hope you learned something from it and you can apply it, and I hope you have a fantastic weekend.